Hi, everyone. My name is Cheyenne. I'm the event manager at SimplePractice. Thank you so much for joining our webinar today on taxes and write-offs. Before we get started, there are just a few things that I want to mention. First off, we're so excited to have you here on our first webinar in our Ask an Accountant series of 2023. We will be hosting many more webinars with Edie and others this year, so definitely keep an eye out for the upcoming webinars to pre-register. Speaking of Edie, we're so delighted to have her here with us today. She's hosted a few of our webinars in the past, and we know everyone needs her wisdom now more than ever, especially with tax season right around the corner. So now I'm just going to get started with going through the agenda. So we have an hour here today, and we're going to start with introductions, and then we'll go through everyone's pre-submitted questions. And then we're also going to leave some time at the end to go through your live questions. So definitely go through and put those in the Q&A panel, and you can find that on the right-hand side. There's also a chat portion. So if you're having any issues or any questions, you can write those in the chat section that's featured to the right of the screen. And yeah, if you're experiencing any technical issues, feel free to write those down below. I will try to respond to everyone as soon as I can. The webinar will be recorded and will be sent out to everyone via email tomorrow. And you can also access the on-demand recording directly using this link that you're on right now, and that'll be available right after the webinar ends today in an hour. I'll let Edie introduce herself, but before I do, as a reminder, if you are a SimplePractice customer and have any questions related to billing, insurance, or taxes within your SimplePractice account specifically, I recommend visiting support.simplepractice.com. From there, you can view our entire library of resources and contact customer support directly. And also, as another reminder, SimplePractice does not provide insurance, billing, or legal advice. All views and opinions expressed by the presenter are not those of or endorsed by SimplePractice or its affiliates. And now with that, I'll hand it over to Edie.
Thank you, Cheyenne. Okay, so I have a ton of material to cover today, all based on your questions that you pre-submitted. And then, of course, we're going to be able to do some live questions. So I'm going to try and talk even faster than I normally talk, which is already pretty fast. And I'm also not going to read all of my slides. You're going to be provided all of the slides along with the recording, so you can get more in depth on some of the slides if you'd like. But for this slide, just for my introduction, I think it's really important for you to know that I do have my own private practice. I'm living the dream. This was part of the pinnacle of what I wanted for my career. So I can relate to many of the things that you're going through on another level, because I too am a private practice owner, business owner. And then prior to realizing my dream, I was an accountant. I still am an accountant. I'm still a CPA. But I think what's important for you to know about that background is that in order to get my CPA license, I had to be a public auditor. So what does that mean? That means that I would go out to a number of different companies and learn how if they were doing it correctly. So that kind of training has really helped me to be able to zero in on what people need to know and kind of that education piece to be able to provide. I'm a big believer in bucket lists, and that little blurb on that last paragraph tells you why, but I'm really passionate about helping you to thrive in your bucket list of having a thriving private practice. So that's where my focus is going to be. All right, first I'd like to talk about a little of the basics. We are going to be specifically talking about write-offs today, so that's going to be a lot of information about the IRS. But there's some certain messages that I've given in all of my previous talks with SimplePractice done last year that I'm going to tell you about how to access that. But I just want to go over some of the basics. I also want to tell you that if you've heard any of my talks, you know that I'm a big rule follower. But I don't know if many people understand why I'm a big rule follower. And one of the main reasons is that I really value peace of mind. I value my peace of mind. I value your peace of mind. And so some people may write me off as thinking, hey, I don't want to hear how to do it the right way. I just want to gain a little information, but Edie's pretty conservative what she's allowing me to do and not do. But the reason for that, the reason that I follow these rules so much is that when you do play by the rules, you've kicked mind clutter to the curb. So you don't have to worry about if you're doing it right or worry about if the IRS is going to send you that audit letter. You don't have to be looking behind your shoulder, right? So while as it may seem like a lot of the things that I say today are going to be, no, you can't do that, I really want to teach you the best way to do that. And, you know, there are over 8,400 people registered for this webinar today. And I first just want to say that is so fantastic that the 8,400 people, in private practice are wanting to learn how to do this right. And I think that's a real credit to you. You know, we always say that you don't learn this stuff in graduate school. And there's a reason for that, because it's not really related to your license on how you practice in the field of counseling or therapy, but it is really critical if you're doing your own private practice. So this is like the postgraduate training for how to do the books of your business. All right, so that's where we're going to focus. But let's just tackle some of the basics. Okay, so to have peace of mind with the books of your business, now that you're a business owner, it means that you are subject to not only income taxes, but both the employee and the employer portion of payroll taxes. So let's also define some terms, because I think there's a little bit of misunderstanding in what I mean by write-offs versus business expenses. So business expenses are your costs of doing business. Deductions or write-offs are business expenses that the IRS allows you to deduct on your tax return. So you may have some expenses that are run through your business checking account, but that are business expenses, but the IRS doesn't allow you to take those as deductions on your business portion of your tax return. Now, remember, if you're a sole proprietor, your tax return, your business tax return, runs through your personal tax return. It's going to be a Schedule C on your Form 1040 of your IRS federal tax return, okay? So for an example, you may make a charitable contribution in your sole proprietorship, but that donation is not tax deductible on your business return. It's very likely that you'll be able to deduct, if you have a sole proprietorship, you'll be able to deduct that donation on another portion of your personal tax return. But that is not a write-off that you're allowed to take on the business portion of your tax return. So that's where I'm going to be focusing today, is what is allowed as deductions on your business tax return, okay? Now, I get a lot of questions about recommendations for having a CPA prepare your tax return. And having a CPA prepare your tax return is really helpful because they'll also be preparing your estimated quarterly tax vouchers for the following year, which is also very helpful because you don't have to worry about how much you need to pay and how much you need to pay in order to avoid tax penalties. All right, so that will already be prepared for you. But even though you might have a CPA preparing your tax return, you're still responsible as the business owner for making sure that you do the right record keeping, that you're keeping your books in the proper way, and that you are categorizing them correctly. So even though you have a CPA preparing your return, they still need to do their due diligence to make sure they're filing a proper return. But you as the business owner are ultimately the one responsible. So just like employers withhold taxes in retirement from your paycheck, you should set aside first a minimum of 40% of your income every month into a dedicated savings account. I go into this in great detail in my earlier webinars, okay? And there are lots of questions today that I received about LLCs and S-Corps and the advantages and disadvantages. But this is going to be specifically about write-offs today. So I really encourage you to check my earlier webinars. If you go onto YouTube and put in SimplePractice and Ask an Accountant, you'll see my earlier webinars. They're long though, they're boring, but you will get a lot of information about LLCs and S-Corps. So if you incorporate just a few habits monthly into your practice, tax time is not a nightmare, which is really great. All right, this is just an example of a slide that I stole from my slides last year. The first presentation that I did with SimplePractice last year was in February, and it was on taxes in general. It was not specifically about write-offs like today. So this is an example of one of my slides. So if you have any questions right now about, when are the quarterly estimated payments due? Do I need to make quarterly estimated payments? Those are all things that I covered in that webinar last year, and we won't be able to talk about that too much because we're going to talk about write-offs specifically. All right, so now we're going to get to your questions. So on the first go around, when Cheyenne and SimplePractice gave me the first set of questions, I had over 400 questions. And so it wasn't 400 different questions. It was 400 I was able to group them into themes. So if you have a particular question, I'd encourage you to maybe listen to these first 4 main subject areas before you ask your question, because I think I'm going to answer most of your questions that you want to post in for the live questions. But the first thing we're going to talk about is credit card processing fees. The next is some version of, and I've got many different versions of this main question, is what happens, what can you deduct if you're not getting your full fee? The basic answer is nothing. But then we'll also go into home office deductions. That's a huge topic. Included in home office deductions is also transportation expenses. And then I'm just going to go over into some overall write-offs and some overall suggestions. Okay, so of the 400 questions that I first looked at on that first go around after the first week of people registering, over 25% of the questions that were being asked of me are credit card fees deductible or some version of that question. And I thought, okay, this is going to be a short webinar because all I have to do is say, yes, credit card fees are a cost of doing business in your therapy practice. So yes, they are tax deductible. I thought, okay, let me delve into this a little bit deeper. What are they really asking? Because if you are a SimplePractice customer, you don't even see if you're a SimplePractice customer and if you're billing through SimplePractice, that's also important. So if you're also working with Stripe, because SimplePractice works with Stripe, you don't even see those credit card fees because you just, like for my practice, if I see a client, I just click the button, yes, charge that client their already established credit card. I don't take insurance, so it's just a simple charge of the card. And then what gets deposited from SimplePractice and Stripe into my business checking account is a net figure. So it's my regular hourly fee minus the Stripe credit card processing fee. So I'm thinking, why do I have all these questions about whether or not that's deductible? So then I created this slide because another version of the question that you're asking me is one of 2 different subjects. Can I recoup those credit card fees by charging my clients for what I'm paying on those credit card processing fees? And what if I'm not a SimplePractice customer, or if I'm not doing my billing through SimplePractice? So if I don't use SimplePractice Stripe's credit card payment system, for example, maybe I accept Venmo, how do those fees become deductible? So I'm going to address both of those issues. All right, can we charge our clients for the credit card processing fees to use the service? The basic answer is no, but I'm going to explain that a little bit. So you may have heard that as of March 1st, the SimplePractice needed to increase just minimally the processing fees for accepting credit cards because credit card companies were also charging SimplePractice more in fees. So, but basically what people want to know, what therapists want to know is, can I pass those fees that I'm paying on to my client? Can I have my client accept that fee? So the basic answer is no. While it might be allowed on a federal level, the rules are by the state. So credit card processing fees, it's all different depending on the state. But for the most part, the answer is going to be no. So let me give you the example of California. In 1985, California said, no, all companies cannot pass along their credit card processing fees to their customers. Okay, so no, you can't. Now, a few years ago, a couple of companies sued the state of California to say, hey, we want to pass those fees on to our clients. And so the ruling was, I mean, I'm really generalizing, but the ruling from the state of California was, all right, for the companies that are suing us, you guys get to pass those fees along. But overall, they didn't take away that law. And so now other vendors, other business owners are left with that choice, like, do I have to sue the state of California in order to be able to pass those fees along? But I would like to offer a different way of looking at your credit card processing fees. So I'm going to offer this different outlook, a different mindset. I would like you to think of that fee as a convenience to you in your business of accepting payment by credit card, because it really is a convenience for you. Let's not penalize our clients when accepting credit card payments is an easier system for me. So let's consider the alternative. If I were to pass those fees on, if I was allowed to in my state, and I passed those fees on to my client, and if I didn't want, well, let's say if I didn't want to pass those fees on to it, but I didn't want to pay those credit card processing fees, think of the alternatives. I could either collect it, my hourly rate by cash, or I could do it by check. Well, now let's say I am 100% telehealth. Now I have to wait for my client to send me a check. So now I have to tell them my home address, because I have a PO box, but for others that don't, you'd have to give them your home address. Now you have to wait for that check to come in. It's really a convenience for me. Now, there is the option where you could offer a discount for being paid by cash or check. So let's just say your hourly rate is $150, and you could say, hey, but if you pay me by cash or check, I'll only charge you $140. I don't think that's a great alternative either, because I don't like any therapist, to lower their hourly rate based on how a client pays. It just feels really wrong. And I don't like anybody devaluing their hourly rate. So this is what I suggest. Include your credit card processing fees as a cost of doing business. And when you accumulate all of your costs, then you may do maybe like an annual evaluation of whether or not you need to increase your fees, your hourly rate, based on the fact that doing business in your state is just increasing. That's a much better way to look at it. And as a consumer, I would feel much better to know that, okay, well, yeah, even in employer situations, you're getting a raise, hopefully every year, and it might just only be like 3% for a cost of living increase. That would be in line. So I, as a consumer, if I was somebody where my therapist said, okay, I need to charge you a little bit more this year, I would think, okay, well, yeah, prices are increasing. I get that. But I have been on the other receiving end where there was a mobile service that I was engaging in, and she increased her fees a lot because fuel prices escalated. And like a lot. And I thought, okay, well, it makes sense to me because she's a mobile service. And gas prices really do affect her because she travels all over to see her clients. And yet I was left with this uneasy feeling, like she just mentioned fuel prices. She didn't call it a surcharge or anything. So I was left with the feeling, well, since we know fuel prices are going to come down. Is your price going to come down? Because she specifically said that was the reason she was increasing her fee. So I would really like you to kind of think of your credit card processing fee. It's tax deductible anyway, as part of your convenience of offering a quick method where you're getting paid in a timely manner. All right, so the next question has to do with, I think there are a lot of questions about whether or not I can deduct my credit card processing fees outside of SimplePractice. So yes, the answer is yes, you can, but now you've got a larger problem because I don't think you're HIPAA compliant. So to be considered HIPAA compliant, payment methods must meet 2 criteria. So they have to ensure that there's confidentiality, integrity, and availability of your ePHI transmitted and stored in their software. So it has to be completely private. This is medical healthcare information that needs to be secure. And also the other consideration is the healthcare client, your client, has to sign a business associate agreement, a BAA. So for example, PayPal, Venmo, Zelle, QuickBooks, Stripe, and Square, all of those are non-HIPAA compliant methods of receiving payment in, okay? So I just give the example, like PayPal not only sells their consumer data, so that doesn't meet the privacy requirement, but they also don't offer BAAs. Venmo sells their data, shares their data with PayPal. PayPal owns Venmo and offers no BAAs. Zelle offers no BAAs. Okay, so you might be thinking, well, why SimplePractice works with Stripe? Yes, and Stripe, I just said Stripe and Square are not HIPAA compliant. Stripe and Square alone are not HIPAA compliant, but SimplePractice has worked with Stripe because SimplePractice meets all of those, those 2 criteria. So everything is secure. When I send an email to my client for the invoice that's been processed, it's all within SimplePractice. So they are not getting an email that has all of the private information. Even just my name and LCSW on my invoice is telling people, if somebody else were to get a hold of that private information, that the person's in counseling, right? So for example, QuickBooks is also not HIPAA compliant, but I'm a big proponent of using QuickBooks. So when I put my invoices into my QuickBooks system, I have 0 identifying information about my client. So so that's how I do it. Now, I gave another example, but I think that's enough. I also give the site that I got a lot of this information from, because I think it's a really helpful blog post. So you have that site there in my slides if you'd like to look that up further. Okay, also SimplePractice in their blog post wrote an excellent article on HIPAA compliance, and they give you some alternatives even if you're not a SimplePractice customer. So I really liked that. Okay, so another question. Okay, so 25% related to credit card processing fees, probably an equal amount related to some version of this question. When my fee is greater than the insurance reimbursement rates, can I claim the write-off when I file my business taxes? So similar questions to this were, can I deduct free sessions that I offer clients? Or can I write off a difference in my fee? So if my fee is $150, but I'm only being paid from the insurance company $95, can I write off that $55 on my tax return? And I'm so sorry to say, but in all the versions of that question, the answer is no. And I'll tell you why. Reduced fees equals 0 write-offs. So when you're reporting your income every year on your tax return, you're only reporting what has come into your business, so into your checking account. You report income on your tax return for what you've earned. You cannot deduct then what you should have earned if you received your full fee. Because if you really extrapolate that further, you could say, well, my billing rate is actually $2,000 an hour, but I'm only getting $95. So I should be able to write off that difference. You could tell me your billing rate is anything, but unless you actually receive that, you're only going to be paying taxes on that income that's actually been received. Okay. So in no way can you write that off. Now, to get a little bit technical, I'll just offer that I've never seen a therapist in their business be anything other than a cash basis taxpayer. So what does a cash basis taxpayer mean? A cash basis taxpayer means that you, in that year, pay taxes on the income that comes in, and you get to do deductible write-offs only for the expenses that go out. So a bill that you receive, if you have not paid that bill yet, you don't get to deduct the expense for that until you pay it, because you're a cash basis taxpayer. So cash basis taxpayers pay taxes on the year that income was received. If you have an outstanding unpaid balance from a client, you can't take a deduction because you've never really recorded that income. So you might say, hey, but I've heard of a lot of companies being able to write off bad debts. Now that applies to accrual basis taxpayers. What's an accrual basis taxpayer? That's just a taxpayer who pays taxes on the invoices they send out, regardless of whether or not they've received that income yet. So if you are an accrual basis taxpayer and you have a client who hasn't paid you, then yes, you could write off that amount, but the requirements for whether or not it's a true bad debt are pretty extensive. So you have to meet those requirements. Okay, so I hope that's clear, but if it's not, please ask some questions, because that's one of the second most commonly asked question. Okay, so I did get this question a lot. What are the most commonly missed business expenses? And it's kind of tough to say that, but in general, I find that we miss our business expenses if we don't have a dedicated business checking account. You could also have a business credit card, but I'm trying to encourage therapists to not use a credit card as much and to just use a business checking account and a debit card. So that's where, if you're an LLC or an S Corp, it's the law that you have to have a separate business checking account. But even for my sole proprietorships, I'm really I can't, that's my number one thing. You have to have a separate business checking account. The IRS can't stand it when there's commingling of personal and business expenses. So commonly missed expenses happen when, let's say you're on Amazon and you want to add a resource for your business, like a book or for your business library, something you think you might use a lot with your clients, or just reference material. That's a deductible business expense, but you're paying it on through your personal Amazon account, or you haven't set up your business checking account as a payment method on your Amazon account. So that's a commonly missed expense. Also, anything that you pay personally is probably going to be missed, or you're going to have to go through all that activity on your business accounts to find your business expenses. And that means a larger headache that you have for the end of the year. Along with that, the expenses that you might miss, it's also common that many people, especially those who accept insurances, that those insurance payments may be going to your personal accounts. So you might also be missing income, recognizing income if it's going into your personal account. You may have signed up with an insurance company before you even had a business checking account. I know a lot of people watched my webinar last year and they're like, the first thing I did after I saw your webinar was I got a business checking account. But in the meantime, they've already been accepting insurance payments. And at that time, that's the only account they had. So it's a real headache to go to the insurance companies, and especially if you take a lot of insurance panels, and have it transferred over to your business account. But you're but you're also lessening the headache that you have to try and keep track of what money has come in and where. Okay, so I like one business checking account for all of your business activity. All right, this wasn't necessarily asked of me, but I wanted to add this question. So what are the biggest mistakes therapists make regarding their taxes? And so I came up with 8 different things to just kind of think about. I just mentioned the first one is the biggest mistake is commingling of personal and business expenses. My next talk in May, we'll give you more information about that, will be on owner's draw. So that's separate from owner's draw commingling of assets, okay? Another common mistake is taking the home office deduction when qualifications for the deduction are not met. Like, even though I'm 100% telehealth, almost 100% telehealth, I don't even take the home office deduction. I'm going to go into that in great detail. Plus, you cannot take the home office deduction when you also have another place that you're renting. So if you have another office space that you're renting, you can't take the home office deduction. Another mistake I see is including both auto expenses and business mileage. It's a percentage of use of actual business miles or your expenses, but not both. So business mileage is not usually computed correctly either. So I usually see that as a mistake. The most common mistake that I see is using your regular commute to your office as business mileage, and it is not. It's just part of your regular commute. I'm going to go into that transportation expenses more too. Not paying attention to documentation requirements. I'm looking at the time and I got to kind of beef it up a little bit. Not understanding what a true business expense is, but hopefully you'll know much more at the end of this. Sometimes we get fancy without understanding what the consequences are of not following the rules of being fancy. If the IRS is giving you a gift of a deduction and savings, there's probably a lot of requirements you have to meet as well. Waiting until the 11th hour to get organized with tax information. And I want to protect your energy. So if you are hyper-focused on the minutia of ways to save money with your taxes, where are you also not concentrating on? What energy is being taken away from maybe marketing or building your business? So I really like to protect people's energy. Okay, huge topic is home office deductions. 2 years ago, I took a continuing ed class for my CBA license. And this was the entire, and it was a long self-study program. And I think I got 6 or 12 hours for it, but it was only on home office deductions. This is an excerpt from that webinar, that home office deductions study. So you have to meet all 3 of these criteria. So we don't even talk about home office deduction if you don't meet all 3 of these. So you have to be in business. They're trying to prevent people who have therapy, a side gig, and it's more of a hobby than actual business. You have to use your home office exclusively for business purposes unless you meet a couple of exceptions. I'm going to talk about that in a second. And you have to use your home office for business on a regular basis. They're just trying to get away from you just, using it once a year or something like that. So that second one is really tough to meet. Right now you are looking at me in my office. I am at the desk where I do all my telehealth. And yet I do not meet the qualifications for using my home office exclusively for business. You might say, well, why don't you just use half of your office? Because I have a closet, I have all kinds of other stuff, AKA clutter, around here that has nothing to do with my business. Why don't you just use half of your office as a deduction? Because I actually do personal stuff here. I do scrapbooking. I pay my personal bills here on this desk. So I don't meet the home office deduction. That doesn't mean that this isn't my home office, which is important, but I don't meet the home office deduction. So I don't use the home office exclusively. Now you might think, oh, you're really going to the letter of the law on that. But the IRS actually mentions this, that they say, if you use your desk or your office for paying personal bills, you don't qualify as exclusively. So it's really hard to meet. So let's say you do meet all three of those criteria. You have you might even have a separate part of your home where you see clients, maybe even, one of those back houses or something. You might have that. So let's say you meet all three of those criteria. Now you have to meet one of these other hurdles. So your home office is your principal place of business. If you have another rental space, that wouldn't be the case then. And then I'll let you read through those. But just so you know, it's really tough to meet that criteria. Okay, now I'd like to talk about transportation expenses. So this is also from that continuing ed course that I took. So transportation expenses are considered a big red flag to the IRS because so many people compute them incorrectly. It's a number one item that the IRS auditors look at when they examine small business tax returns. Okay, so there's a lot of information here, but let me just kind of break it down. All right, now, when we're talking about business auto expenses, you can only deduct local trips that are for business, that is, travel to a business location. A business location is any place, it seems obvious, but man, IRS is really particular about terms. A business location is any place where you perform business-related tasks. All right. Okay, so your office location is where you begin to commute mileage. Since I do some crisis intervention with companies, so I go out and travel to companies. It's a minimal part of my business, but I get to treat my home office as my place of business where I start computing mileage. If you have a rental, if you rent space at another location, that location is considered your home office where you start to do your mileage. So in other words, if it takes you, if you're 10 miles away from your office, from your home to your office, and you have to go to a corporate job where you're going to provide some counseling, and that is 25 miles away, you can only use 15 miles as your business mileage because you have to deduct the commute to your regular office. All right. So accumulate your business mileage during the year. I'd really encourage you to not wait till the end of the year. I've been known to do that many times, so learn from my mistakes. But accumulate your business mileage. There are apps that you can use. QuickBooks also has that feature built in, but there are also independent apps that you can compute your business mileage. I haven't found them to be very user-friendly, so I haven't used them. I haven't even used, well, I think I tried to use QuickBooks, but I just keep an Excel schedule of my business mileage. Regardless of the method you use, you do need to know how much you use your car personally versus for business mileage. So you do need to know your overall personal mileage versus business, okay? My recommendation is to use the standard mileage, especially the first year you're going to take auto expenses, and that's because record keeping is not as extensive. I'm not sure how therapists, especially telehealth therapists, have a lot of business mileage. My guess is you don't have very much business mileage. Remember, if you have an office outside of your home, your commute from home to your office is not part of your business mileage, like I was just explaining. So if you're 100% telehealth at home, your business mileages are likely very little. I mean, yes, your mileage to the bank to deposit checks counts and stuff like that, but I just can't imagine that it's very extensive. So in the first year that you use a car for business, use the standard mileage deduction, even though you might get a better method with the actual expenses, because if you don't use the standard mileage first in that first year, you can't use it later on. You can go back and forth, but only if you've used that standard mileage method the first year. Again, it's a weird IRS quirk, but it's a rule. Okay, so this is how you compute your standard mileage deduction. You accumulate all of your business mileage and you multiply that by the standard mileage rate that the IRS sets. For example, the 2022 rate is 0.585, so 58.5 cents per mile. And that is your deduction on your tax return. All right. So I also get lots of questions about business trips. So the key word in this sentence is primarily. Your trip must be primarily for business to be deductible. Lots and lots of rules. I don't really have time to go into all the rules on that, but just know that a vacation that, oh, you got to do some business on the side does not mean you get to deduct the costs of travel to get there. Okay, so meals and entertainment is the line item, but really we should just call it meals now, because for quite a number of years there are zero deductions for entertainment. Okay, so we're only talking about meals now. And the standard has been that the IRS has allowed 50% of your meals to be deductible. Business meals. And that's key, because you do still have to meet those requirements. But during the pandemic, restaurants were really losing money. And so the IRS wanted to encourage business owners to start using restaurants, to start eating out. And so they allowed for just the 2021 tax year and 2022 tax year to have 100% of your business meals deductible. But you still have to follow the requirements. In order to be deductible, you have to keep the receipt. And on that receipt, you have to document the business purpose, who you met with, and the business relationship that you have. Also, to follow the rules, it must be from a restaurant. So you can't deduct grocery store purchases, or they even specify not the prepackaged meals. Those do not qualify. The cost of the meal can include taxes and tip, but transportation to that business meal is not deductible. And the cost of the meal has to be separate from any entertainment cost. They do actually specify this, and this does, in my opinion, apply to therapists in their private practice. So let's just say you have this opportunity to be part of, like, not a group supervision, but like a group where you talk about cases and you really provide that support and case consultations. And you decide to meet afterwards and have a meal together. If you are part of a business acquaintance and you all take turns picking up the cost of the meals, and there's not really a business purpose to that meal, they specify that that's not tax deductible. So again, we want to be really careful. We don't like to do things that are going to kind of be red flags to the IRS. So the meals requirement is, there are a lot of rules to it. So if you want to err on the side of caution, I would be just really careful with that deductibility. I do get this question at times, but basically I'm just going to say, and you'll have the slide, but basically the only people that get to deduct health insurance premiums on their business tax return is if you don't have any other source or eligibility to be on a different healthcare plan. So like my husband is in an employee relationship and his company offers him health care for all eligible members of his family. So I could not get my own health care insurance through my business and have those premiums be deductible on my insurance plan. On my business tax return. Okay, so I just want to kind of give some summary answers to some common questions. So you can allocate a business percentage of your home internet and cell phone use, but you have to justify your business percentage. So if there are a lot of members in your home and you're taking 100% of the internet expenses on your business tax return, that's going to be a difficult one to justify why nobody else is using the home internet. So you really want to be careful with that business versus personal percentage. So even though I don't qualify for a home office deduction, I am allowed to take my home internet. I compute a certain percentage of my business use for my internet. And I do use my cell phone in a limited way, so that percentage is not very high, but I do get to take some of my cell phone use, as well as I have a dedicated landline. I'm in the old ages, but I have a dedicated landline for my business. So those expenses are isolated. Those are separate. Those are definitely for my business and tax deductible. Okay, now you're going to see some differing opinions on this with different CPAs, but supervision is deductible. However, I should have really said, because supervision is a cost of getting your license, right? So if you're in private practice, yes, that cost is deductible, just like case consultations would be deductible. But individual therapy, just like any other individual, not a therapist, is considered a medical expense. So not deductible on your business tax return. Again, some therapists would say differently. I'm sorry, some CPAs would say differently, but that is how I believe in my reading of deductions. Think of it with the example of a doctor. If a medical doctor is going to his own medical appointments, we really want him to be going to his own medical appointments. We want him to be healthy. But we would never think that, his copays and his medical expenses would be deductible on his medical practice's tax return, right? So even though, yes, oh my gosh, yes, individual therapy is so essential for self-care, we absolutely recommend that you're in therapy as a therapist, but it's considered a medical expense. How do you compute income if you're not using a system? So if you don't have any kind of system of figuring out how your income is, what the best way is, the easiest way, and what most CPAs do if you don't have a formal system, is they would ask for your 12 months of the year bank statements, if that's all your income is recorded in there, and they would just total up all that income. Now, if some of it wasn't related to actual income in your practice, like if you had investments in your business, like if you were investing money in as an owner's investment, then that would be deducted. But that's one system. Also, you could use your figures with SimplePractice. If all of your information is all of your billing is run through SimplePractice, that's an easy way. And you could compare that figure with what you're getting into your tax return. You could do, your bank statements, you could do that as well. But just make sure insurance companies also have to report to you how much they have paid you during the year. But if you also have that information in SimplePractice, you don't want to be doubling that income, because let's just say Anthem, you accepted Anthem, but you did the billing through SimplePractice. Well, they're going to record those payments that Anthem made to you. So it's just Anthem is meeting their requirements of telling you. So you want to just make sure that all of what Anthem is saying is earned is also in your SimplePractice, if you're using just your SimplePractice as your total income. Okay, so with all advice, make sure it passes your own reasonableness test. If a colleague tells you, oh, hey, you can totally write that off, I do, and it doesn't seem reasonable to you, then, really trust your gut instincts. Back up everything with documentation, and just be careful about this employee versus independent contractor. It's a big, huge topic, and I don't want you ever to be in a situation where the IRS were to come and say, uh-oh, you know how you thought you had an independent contractor on helping you? That's actually an employee, because you do not want to suffer from that situation. Okay, I'm just going to throw this out there because now I want to get to your live questions. But if you are in multiple states, couple of things. One is I highly, highly recommend you get a CPA. Not only, you don't have to have a CPA who's familiar with therapy and has that niche with therapists, although kind of would help in this situation, but you want somebody who is really well-versed in earning income with a license in different states. You're fine with federal. You're just reporting your income federally on all your income earned in any state. But if you're licensed in multiple states, you won't have to pay double state taxes, but you probably have to file different state returns. All right. So I'd really like you to have a professional tax preparer advice and guidance on that. Okay, I'm just going to throw this out there. I just wanted to show you that my process when I would audit companies, and this is very similar to what the IRS would do. The auditor's process is they go out to a company or they go out to your business if you're being audited by the IRS, and they choose a sample of transactions to look at. So they want to see the documentation for a sample of transactions, primarily expenses. Okay, so they want you to prove to them that that's a legitimate expense. If you have no way of proving that in that sample of transactions, let's say they've chosen 10 transactions and 4 of them don't have the right documentation, then they're going to do one of 2 things. They're either going to increase how many transactions they look at, or they're going to not include any expenses until you can prove any of them. So I don't want you to be in that situation. So I just want to make sure that your documentation is rock solid. All right. So if you're hungry for more, I offer individual consultations and all those other things. So I'd be thrilled if you reached out to me and wanted some additional help. I just add at the end, I love to write. Yet I write all these blog posts and I really have a feeling nobody reads them. So I will put you at the head of the line if you show me you're a reader of my blog. Okay. So, all right, Cheyenne, take it away. Live questions.
All right, I'm back with our live questions. We have a ton, so I'll start putting them right here on the screen. So our first question comes from Brittany, and I'll just share that right here on the screen. How does the multiple state taxes apply to the Telehealth Pact, allowing clinicians to provide telehealth reciprocity? Do we still need to separate state income tax?
Yeah, it's a great question. I don't feel like I'm the expert in this at all. I don't even think the states understand exactly what's going on. I do know that this is an area where there is very little compliance with. There are many people who have licenses in different states, and now these many states, like you're mentioning, Brittany, have this consortium where they've got this pact that, okay, they're all together. I don't know. I just don't know enough about, I feel like, I think California, Nevada, and Washington, if they haven't created a pact, I think they're starting one. I don't know if that pact that those states have is the same as maybe an East Coast pact. I don't think they are. So they, everything varies by state. So I would hate to give you advice because I really don't even think the states have figured out how to track that. But if you do have licenses in different states, hopefully there is a CPA on your team that can guide you with that. The best way to do it is to practice in the state that doesn't have state tax returns. There are like 9 states that don't. But other than that, it's just a super gray area right now. So I'm really sorry. I don't know how much I can help you on that. But it is an issue. I don't know how much the pact separates whether or not you have to file state tax returns. So I'm really sorry. I'm not very helpful. If you want to send me an email, though, I can do some more research and then I can get back to you.
All right. And our next question, are insurance premiums I pay for Medicare insurance deductible?
Are insurance premiums that you pay for Medicare, would that be, can they reply back? Are you asking if your own personal Medicare insurance premiums that you pay on your health insurance, are they deductible? They would be deductible if you don't have the ability, your Medicare. So I think you're asking for personally, if your personal premiums that you pay on Medicare, if that is the only access eligibility that you have for health insurance, then yes, it is.
Okay. There were a bunch of questions about home office expenses, but specifically related to furniture and internet, if you can cover some of those.
Sure. So the internet, hopefully, I've answered the question that you just need to figure out your business percentage of the internet. So like at the time that I had my two sons home, now they're in or out of college, there were four of us who were using the internet all the time. So my business percentage as an expensive business was less than a quarter. And so you really have to do that business versus personal percentage. So you can take the business percentage as a business tax deduction. Okay, so if you are buying the furniture is considered a capital expense. So what does that mean? That means that it's usually kind of a big ticket item, right? Especially if you add up like all of your capital purchases, like maybe computer, printers, all that stuff. Those are all considered larger items to capitalize. What does capitalize mean? It means is that we're going to put them in as a fixed asset on your balance sheet. That's all mumbo jumbo, a lot of words, but basically what that means is you would take a depreciation every year. So you'd write down those assets every year. If you're spending, let's just say you need a chair for your desk and you're 100% using that chair for your business, then yes, you can capitalize 100% of that. But even though you're going to capitalize the expense, if you use it for personally, you can only take the business use percentage. So again, send me an email if you have questions about that on furniture, but furniture, computers, any big ticket items. And what's a big ticket item? We usually say, as everybody's business is different, but anything over $500 is usually considered a big ticket item that we wouldn't just have you write off in that year, because you have to allocate that expenses based on the depreciation guidelines.
Okay, great. Another a little bit specific question. This one comes from John. Is it true that as a sole proprietor therapist, it's not possible to form an LLC in California?
Yes, it is true. We cannot be LLCs in California, but you can be an S Corp. But if you see some of my previous webinars, I mean, I've been in my own business since 2012. But first it was just accounting, and now it's private practice too. But I'm still a sole proprietor. So you do need that protection, but you can get that protection by being an S Corp if you're in California. But yes, it is true. You could incorporate in California as a personal service corporation. But yes, to answer your question, yes, that is true. It's not possible to be LLC in California. It's crazy.
Okay, we have one more question here from Joseph. How do you calculate supervision money-wise if you supervise interns?
Okay. Let me just, on that last question, let me just say, it's not that nobody can be an LLC in California. It's just therapy. Mental health therapists are one of the professions that the IRS has not allowed, because it's a personal service that they're providing. So they have, I don't know, I think it's like 5 different professions that are not allowed. Okay, so how could you calculate supervision money-wise if you supervise interns? I'm trying to think about why you need to calculate supervision money-wise. So I'd like to know why. Maybe Joseph, can you send me an email on what the purpose is for calculating that supervision money-wise? So are you asking what benefit you're providing to this intern? So the interns are trying to say how much they can write off as supervision costs. Remember, anything that we write off, it can't be, it has to be what we're actually paying out. So the reason that you can't deduct or write off the difference between your hourly fee and what you've actually gotten in is because you haven't lost any money. You haven't paid any money out. Yes, you've lost some money in between there, but you haven't paid anything out. So that's why. Just send me an, sorry, I keep saying send me an email, but I would like to know a little bit more about what you're trying to do to calculate that supervision part.
And we're coming up on time, but we'll do one more question because there were a lot of questions about continuing ed courses.
Sure.
So you mentioned supervision is deductible. What about certificate/program costs, licensure renewals?
Yes, yes, and yes. I'm so happy to be able to A, answer a question, and B, to be able to say, yes, totally tax deductible. This is your cost of doing business. You need to spend so much money in renewals, certificates, licensure renewals. Yes, all cost of doing business, absolutely 100% tax deductible.
Amazing. Okay. Well, thank you so much, Edie. Thank you, everyone, for joining. We don't have time for any more bonus questions, unfortunately, but Edie did go ahead and answer some other additional frequently asked questions. So we will send these slides out afterwards, and you can definitely read through all of these. And yeah, just as a reminder, you will be emailed a copy of this webinar recording along with the webinar slides so you can view them at your leisure. This will also be uploaded to our YouTube, and you can also access the recording directly using this link after the webinar, same link that you're using now. And we'd love to have you join us for our next Ask an Accountant webinar, and that's going to be on owner's draws, as Edie mentioned. That one's going to be on May 18th. And as another final reminder, be sure to sign up for Pollen. You can get all of our latest industry news, tips for practitioners, resources, checklists. All of our webinars will be uploaded there as well. You can go directly to simplepractice.com/pollen. And just as we wrap up here, I wanted to thank you all again. We received so many amazing questions, and there was such great conversation in the chat. So thank you, everyone, for joining. Thank you so much for Edie. This was so helpful for everyone. I'm sure there will be a lot of follow-up questions coming to you on email, and we look forward to seeing everyone here again in 2 months. So see you all May 18th. Thank you again, Edie. This was fantastic. Okay, bye all. Bye-bye.